We know each other a long time. I want to start with the day you started in the business. Tell us a little bit about the day that you started the business. And then we're going to go to some of the things that have shifted in the economy and the world and have gotten these things right and where you think we are now.
Anthony, you're going to make me sound like a dinosaur. I started in June of 1987, right before the October crash. And what's been amazing is lived through the S&L crisis, the Asian crisis, the dot-com bust, obviously 2008, obviously COVID. And if you put $1 into the S&P on the day that I started work in June, it's worth $35 today.
Wow.
If I were smart enough to have put it in the NASDAQ, it's worth $84. And so one of the things that just makes you realize is the value of being long-term focused and staying away from the noise. And that was something in my past career at Brown that I think we did a really good job of. Think about the long term. Stay calm during all of these current events that seem to take people away from compounding their capital.
Yeah, no, I look, everybody's a long-term investor until they have short-term losses, then they freak out. I've experienced that in my career. But you got something really right. And again, you're not going to say this, but I'm able to say this for you. You understood the dynamics of what was happening with the Fed right after the 2008 crisis. So tell us from an analytical point of view what you were seeing and why you were so confident in the directionality of the Fed's zero interest rate policy. Turned out to be for almost a decade and a half. What were you seeing and why did you have such high conviction back then? Then I want to talk about the paradigm shift.
Sure. I think that the great experiment of quantitative easing, where the Fed took the balance sheet from 1 trillion to 9 trillion, was a super powerful catalyst to drive capital all across every asset class. And it really boosted things like venture and growth, and that's really where you wanted to be. And the value of the Fed put, the concept that every time there was an issue, the Fed would come in and ease. And so you just had to have that in your playbook and understand that they would always come to the rescue.
Okay, but you and Dave Tepper, I would say, are the two people that I've talked to in my career that during that time period were very confident that the Fed was going to continue to do that. There are others that were a little more skeptical and felt that, okay, at some point the punch bowl that the Fed put out is going to be taken away.
Right.
So why? What was
the catalyst was inflation, right?
Okay. So the fact that there was no inflation.
Sure, because we had globalization, and globalization was pushing rates down and inflation down as people accessed low-cost labor and goods throughout the world. And so when we talk about
it gave the Fed a wider berth and more laxity.
We had no issue with inflation.
Okay, so let's talk about what's happening now, because we are seeing a paradigm shift. Tell us about the data, how you're interpreting the data, and where do you think we are now?
So I think we're in the midst of a big paradigm shift where we've gone from QE, a QE world, quantitative easing world, to a quantitative tightening world. And it has huge implications for portfolios, for asset allocation, and how you think about every asset class. And instead of increasing the balance sheet, now the Fed is taking away liquidity, works out to about $95 billion a month, $60 billion in treasuries, the balance in mortgage backs. They're actually not selling these securities, they're letting them run off, but the effect is still the same. And when you do that, stuff breaks. And what was the first thing that broke? Regional banks. Now, the last time we actually did QT, the repo market backed up. And then we had trouble with the money markets. So we enjoyed QE, it was a wonderful period, but now we're faced with QT and its implications.
Okay, so I just want to ask your opinion of behavior. So we get conditioned to low interest rates, or in the case of the Fed indicating that they're going to raise rates, we've got certain regional banks that need to make money, and they're playing the long game, and they're perhaps not hedging their treasuries properly or hedging the capital structure properly. And so now they're underwater from a mark-to-market position, and we're starting to see this cascade of failures. Deflationary?
So that in itself is absolutely deflationary. I can tell you in terms of inflation, at Blackstone we have about 260 private companies, and we monitor all that data. And what that data is telling us is clearly inflation's coming down and wage pressure is decreasing. It's also telling us that the companies are hanging in there. Our portfolio is really doing quite well. And I know if you look at the forward interest rate curve, it looks like the world is about to go into a recession. That's what the bond market's telling you. We're not seeing that in our core group of companies. But as we were talking earlier, Anthony, I do think that when we were engaged in rapidly raising rates and QT, the effect of these regional banks, which account for 40% of all the lending in the country and 60% of all real estate, it's real. And what are you going to do if you're the CEO of a regional bank right now? So I'm a CEO of a regional bank. I lend out 75 to 80% of my deposits, and half of them are uninsured. How can I keep doing that? So you're going to see credit's going to get a lot tighter, and the credit that's in the regional bank system is the fuel for the economy, for real businesses, right?
The small businesses are really where the jobs are created, and if you slow down the lending there, it's going to crimp the system. But just from a public policy perspective, it's come out in the minutes, come out in the research. The Fed knew that there was going to be a problem. They decided to raise the rates anyway. There were people inside the Fed that anticipated the problem, told the board that there would be a problem. And so now they got the problem. What would you recommend from a public policy perspective? Is there something that...
Well, this is the real dilemma, right? Because if you're essentially saying, and I think the administration doesn't have a policy right now in terms of whether they're going to insure deposits or not, and that's above my pay grade, and we're going to let them decide what they're going to do. But I think that we would encourage them to carefully take a look at it. And the reason is that this is the lifeblood of our economy. So we're in a QT world, money's coming out of the system, and the implication is it's a head wall for stocks. And I think the playbook is different because you have to ask yourself different questions when you're in different environments. And I think the question that you need to ask yourself as an asset allocator is, how much of my portfolio is dependent on stocks going up? How much of my portfolio, is correlated to multiple expansion or contraction?
Yep.
What's the yield on my portfolio? Because in a QT world, we have a new asset class.
Right.
It's called cash. It's back. It had disappeared for so long.
So I want to stay on this for one more second, then switch, but because we're both old enough to remember the RTC. The RTC created, the government put the bad assets in the RTC, gave space for the banks to re-equitize. Quantitative easing, they more or less allow them to re-equitize off the Fed, right? Borrowing at zero, lending at a few percent, they re-equitize. Is there something that the Fed could do right now in the system, maybe a 2-year FDIC will guarantee up to $10 million?
Well, they've done that before, right?
Exactly, yeah. So I was wondering, why are they not doing it now?
Well, I think implicitly they are doing it in the sense that when a bank fails, they are stepping in and guaranteeing. But the moral hazard of just declaring that, there's about 19 trillion of savings in the regional banks deposits. So that's the number, and 9 trillion of that is uninsured. That's as big as bigger than the Fed balance sheet right now. So it'd have a lot of implications.
Right. So where's the investment opportunity, Joe, given the backdrop that we're discussing?
So right now, you're going to get equity-like returns in credit, and it's the number one place to be.
structured credit, direct lending,
Everything from, I mean, you look
MBS.
you look at CLOs, everything from the double Bs are at 13.5%, high yields at 10.6. There are opportunities, and they're only going to continue. And the reason is that we have over $2 trillion of debt coming due in the next 2 years that was financed in a zero interest rate environment. That is a huge opportunity for people to come in and fix the balance sheets of great companies that were just financed at low rates.
All right, so
I'm
you're
very
the-
bullish
you're
on
the
that opportunity.
Debt markets, equity.
So I think, look, I'm very constructive on international equities because of the spread, the PE spread. It's call it 12.5 versus 18 for the U.S. And look, I started the talk by saying, if you look back and put $1 in the S&P from when I started my career, it's really done well. So again, I don't want to come off as being too bearish.
If I'm starting my career today, and it's 35 years later, will $1 go to $35?
That's a really good question. Probably.
Probably, right?
Probably.
So you're confident
It's
you're
done
long-
even better for Buffett.
Right.
And I think, I mean, that's one of his secrets is the long-term compounding nature
Right.
of investing in the U.S.
Right. So there's an optimism, cynicism balance, and it's important for investors, long-term investors, should stay optimistic. I think that's the message.
100%.
Joe, you look great, okay? Because I'm admiring the suit, the tie. Is this how you dressed at Brown University?
No.
See, Joe used to work for a non-for-profit, Brown University. He took it to the top of the leaderboard in terms of its 1, 3, 5, 7-year track record. But now he's working for profit, and I'll probably be going to his tailor after this talk. But tell us the difference between Brown University, non-for-profit, and Blackstone, which is, to me, the gold standard of our industry.
So there's obviously lots of differences, being in a not-for-profit versus Blackstone, but there are some common threads. Very dedicated people that are masters of their craft, who are deeply passionate about what they're doing. And I certainly found that at Brown. Here at Blackstone, we run a high-performance culture, and it's centered on teamwork, a lot of transparency, communication, and there's definitely an ethos of continuous improvement, constantly getting better. So I've really enjoyed the switch. My wife says, you're like Benjamin Button, you're living your life backwards. You should have been at you should have been at Blackstone early in your career and then at Brown, but I'm doing things backwards.
Perhaps as we get older, we become better investors. Certainly Warren Buffett thinks that. Let's go to Steve Schwarzman for a second, if you don't mind. I'm a huge fan of Steve's. I've had the chance to interact with him over the years. What's it like to work for the legendary Steve Schwarzman?
So a lot of people think that Steve is on the periphery of the business. That is absolutely not true. He is so active and engaged. For instance, we have a meeting with him bi-monthly where he's grilling us on our portfolio, and my team loves it. They love it. So he's very active, very detail-oriented, and I feel like I get a master class with Steve where you ask him a question, and he has that ability to really synthesize things. John Gray is the same way. They're able to take concepts when you ask them a question and simplify to such an extent, make it so clear, it's super powerful.
So Brown, when you took over, was at the bottom of the league table from a performance perspective for the Ivy League endowments. You took them to the top of the league table. Tell us about some of the changes that you made at Brown, culturally, attitude-wise, related to performance, investment discipline. What did you implement there?
Well, the first thing is we had a great team, and I hired people who were fundamentally investors. So if you look at Jane Dietz, who's the CIO right now. She had an illustrious career as an investor, and she worked at Fortress for over a decade.
Sure.
So we also hired a lot of people who were Brown grads. Before I came to the Brown office, they only had one graduate of Brown. And so I looked for people who in their family had a history of public service or were teachers, and they tended to have the same value system, or people that went to Brown. So it's super powerful. So that's the first thing. Investor-centric people, partners that you're working with. The second thing is that it's not that we were so smart at Brown, it's that we utilized the network. So imagine all of the alumni who are in private equity, who are in VC, who are, fantastic hedge fund managers, long-only managers. And we used and mined that group of individuals to help us to scout for new managers and for opportunities. And that network effect was super powerful. The third thing was we were outsiders. So I wasn't in the circle of what I would call a pretty clubby group. We weren't in that circle. So we had to be independent, a little scrappier, and we just did things our own way.
So, Joe, we have a lot of friends in common, and I know a lot of your coworkers and colleagues. And so I did a little bit of research for this conversation. And the resounding feedback is that you are an incredibly humble guy, given your success and given all the things that you've gotten right over your 35-year investment career. And we both know people in the industry that are less than humble. So what is it about you? What is the secret sauce about you where you've given off this aura to people, which I think is helping them in their jobs as well? I think it's an important ingredient to the teams that you've built.
I don't know if there's any secret sauce, I'll tell you. I think...
did your dad beat you, as an example?
No.
Or, something like that?
Not on a regular basis.
I just thought I'd throw that out there. Right. Make sure everyone's listening.
I think anyone that has been involved in team sports understands, like, whether it's football or whatever it is, I may be the quarterback, but without all the other players on the field, I will get killed. And so I think it's the team ethos, and also, I'm just a kid from Rhode Island, so I sort of feel like I've been blessed, and I pay it forward and help other people. And I would say my family keeps me very humble.
There you go. Right? You have a good grounding wire. If you're looking at a investment professional, and I asked Steve Cohen this question last night, Blackstone is going to see some of the greatest resumes in history, but there's something that you're looking for that's not on the resume. What is that, and how do you discern that? How do you get that out of the person?
It's resilience, Anthony. I'm looking for people that have been punched in the face and then get up again. And
I'm going to have my staff put my resume together. Okay, we'll see if we can work together. All right, but go.
No, I think it's really important. It's like, so many people who have had hardship and things happen to them, but they still get up and they still fight. And you started off with Steve Schwarzman in his book, which I made my entire family read. He has this unbelievable chapter on when he was first trying to get into the private equity business. And he went and he did 200 meetings and was rejected at each one. But he just kept going. Mm-hmm. And I think it's that kind of resilience and that kind of optimism. How many people would continue after meeting 150? Like, that's what I'm looking for. So and you can't necessarily get that on a resume. I tend to really like scholar athletes for that reason. If you have a full-time job while you're going to college, and you're having a coach yell at you, and you're having to fight to get on the team every day, it's super powerful.
Tell me about your biggest mistake. something that you look back in your investment.
Do we have another 3 hours? I have a PowerPoint.
We got to get a Reader's Digest version of it, because the best investors make mistakes and then they figure out what they did wrong and how they recalibrate. Tell me about something you said, okay, I got that wrong and
Oh my gosh.
I learned XYZ from it.
Seriously, we could do a 3-hour session. I think I've made every mistake. Being too short term, not being too optimistic, being too pessimistic, being too concentrated in a portfolio, being too diversified in a portfolio, not getting the factor exposures correct, not volatility adjusting positions. You name it, okay? I've lived through it.
How do you make the adjustment? Like some people get very, very stubborn. They get locked into something. They want to prove the market wrong. It's going in the wrong direction for them. How do you take your ego out of something and make the adjustment? What are the factors that go into
that? Yeah, I think it's really having a ethos of looking at both sides of the equation and never being so sure, that you get locked in and then you just start looking for facts to support your base case. And so I'm very observant about that and making sure I don't fall into that trap. And anyone that's spent time with me knows whenever I talk about my opinions, I say what my wife says about me, always opinionated, often wrong. And that just sort of keeps me really grounded.
Some of us have married the same ethos. Let me ask you this before I let you go. We're contemporaries. Steve Schwartzman is probably 77, 78. Warren Buffett is 91, heading for 92. Hank Greenberg, 98. Where are you going to be? Are you going to stay in this? Is this the love of your life like those guys?
100%.
Or are you going to be sailing in the 𝐬𝐿𝐺𝐵 Bay? What are you going to be doing?
I mean, I have a dream job. I'm lucky. My dad retired at 90. He was an ophthalmologist in Providence, Rhode Island. He's still playing golf at 96. So, I'm not anywhere near done. Excited.
You do a tremendous amount of reading. What is something you're reading right now that I can share with our delegates here that they should be reading?
Yeah, so I've been rereading Paul Volcker's biography, which is called Keeping at It. And one of the interesting things about the book is you really learn the Fed mentality or fear about being cast as Arthur Burns. Arthur Burns was the Fed chairman who, under Nixon, lowered rates in the fall and created that wave of inflation. Inflation got out of hand. Mm-hmm. And I will tell you, Powell does not want to be Arthur Burns. And when you go back in history and really study it, you'll see why. Many Fed chairmen have lived through recessions, but you don't want to ignite the inflation fuse.
Has he done that? Is he Arthur Burns?
I don't believe so. I think he's being very vigilant, and that's why rates are probably higher for longer. And I think that's the camp that Blackstone's in. So I think Powell is very aware of Fed history, and inflation after it goes over 3-4%, a lot of it's psychological. Right? And you start changing behavioral patterns. And that's pretty clear in Volcker's book.
So I'm going to ask you to guess, and if you feel uncomfortable about it, you don't have to answer. But if we're a year out from now, is inflation higher or lower a year out from now? Based on the portfolio companies you see and everything.
Yeah, it's definitely coming down. And we know 1/3 of the CPI is related to rents, so we have pretty good visibility there. Mm-hmm. But I think it's going to be more persistent than people think, and I don't think that's a market moving commentary.
Right.
I think it's going to be hard to get down to the 2% rate.
Right.
If you look at the average rate of inflation during the history of Blackstone, which I just ran it, it's about 3.4%.
Okay.
And you know what? It was a great investing environment.
And would the Fed be comfortable with that? But they probably wouldn't admit it, but would they be comfortable with it? Say, okay, we don't have it down to 2, but we've got it in the 3 to 4% zone. Would they be comfortable with it?
Probably above my pay grade.
Right.
I don't know how they're thinking about that. Will they move the goalposts? Okay. I think there's a high probability that maybe they will, because the argument will typically be it's structural.
Right.
If you think about like deglobalization, we didn't talk about, but Gina Raimondo, who's the Secretary of Commerce,
former governor of Rhode Island,
orchestrated the CHIPS Act. We're bringing supply chains back to the U.S., and that is fundamentally inflationary, right?
Yeah, of course.
I don't think I'm going to be controversial in saying decarbonization is also inflationary. And so there are structural factors which are inflationary, which would probably keep it a little bit higher than it was in the sort of 13 years of globalization where we were really pressing things down.
So we're wrapping up, but I'm leaving this conversation very long-term bullish on the future of the U.S., the productivity, and the expansion of the stock market, credit markets, et cetera. Do I have that right?
100%. With the biggest opportunity in credit, and really focusing on this opportunity of $2 trillion that has to be refinanced in the system. And I think the regional bank issue only makes that opportunity larger. And so I think the Fed will be monitoring that.
Joe, it's always great to be with you. Thank you so much for sharing your thoughts with our guests.
Thank you, sir.
Thank you, Joe. Now.